When you first come into trading, everything feels either too fast or too slow. Day trading feels like you're trying to survive a tornado, and long-term investing feels like watching paint dry. Somewhere between those two extremes, there's a rhythm that many beginners don't immediately see. A pace that lets you breathe, think, analyze, and still catch meaningful price movement without needing to stare at the screen all day. That rhythm is swing trading. And today we're going to slow everything down, take a deep dive, and talk about what it truly means to trade the market over days or weeks rather than seconds or minutes. You're listening to the Ultimate Trading Podcast for beginner traders. And I'm Isabel Maria, here to walk with you into one of the most practical, dynamic, and beginner-friendly trading styles that exist. Swing trading is the middle ground where most new traders eventually find themselves. It's that space where you're not fighting the noise of the intraday battlefield, but you're also not committing to a multi-year buy and hold. It's a strategy designed to capture price swings, those moves that unfold across a handful of days or sometimes a few weeks. And what makes it so powerful is that it's grounded in logic, technical structure, and patience. You're not following every tick. You're following the swing. When I first learned swing trading, one of the things that surprised me was how methodical it actually is. People think swing trading is simply buying low and selling high a few days later. In reality, it's a discipline built on identifying trend direction, evaluating momentum, reading price structure, and striking that fine balance between reacting too slowly and reacting too quickly. You want to participate in the middle of the move, not the extreme high or the extreme low. And for beginners, that can be a revelation. You realize you don't need to catch the full move. Just a portion. A clean slice of it. And that slice, compounded over time, builds your equity curve. Swing trading relies heavily on technical analysis. You're constantly looking at moving averages, RSI, MACD, support and resistance zones, and chart patterns that help you understand whether buyers or sellers have control. You're looking for alignment, the trend moving in one direction, momentum confirming that direction, structure giving you clean levels to act on, and volatility staying within a range that fits your risk tolerance. You learn quickly that the charts are not just pictures. They're maps. And the time horizon of swing trading makes it accessible. You don't need to babysit trades from 9 in the morning to 4 in the afternoon. You can review your positions with intention. You have time to think. You can analyze after work. Place your orders, and let the market do its thing. That's why so many traders gravitate towards swing trading. It fits into real life. But accessibility doesn't mean simplicity. You need discipline, because the market will always test you. It will always shake the tree to see who falls. Let's explore how swing traders think. We're looking at time frames like the 4-hour, the daily, and sometimes the weekly. We're watching the 50-day and the 200-day moving average because when those two cross, it tells us a story about who's been in control and who is taking over. When the 50 crosses above the 200, traders call it a golden cross, because historically that signals bullish momentum. Conversely, when the 50 crosses below the 200, you know the market is weakening. Then you have RSI, showing you whether the market is overextended. Above 70 and things might be overheated, below 30 and it might be too beaten down. Meanwhile, MACD helps you measure momentum shifts beneath the surface. Price patterns like head and shoulders, double tops, double bottoms, flags, pennants, all of them tell you if a trend is continuing or reversing. And then there is the silent hero of swing trading, support and resistance. Nothing in trading works without clean levels. These levels tell you where price reacts, where it bounces, where it pauses, where it breaks. They are your battlefield markers. They show you where to enter, where to place your stop, and where to take profit. But none of this matters if you don't understand risk. Swing traders depend on stop losses the same way pilots depend on altimeters. Without them, you're blind. A stop loss protects you when volatility expands unexpectedly. A position size keeps your account safe from emotional decisions. A risk-reward ratio ensures you're not taking 1 unit of risk to earn half a unit of reward. You want setups where the math is on your side. 1 unit risked for 2 or 3 units potential reward. That way, even if you lose half your trades, your account still grows. And this is where beginners often struggle. They want to be right more than they want to be profitable. Swing trading teaches you to prioritize profitability over ego. Let me bring all of this into a real story so you can feel what swing trading is actually like. I want you to imagine someone named James. James is not a beginner. He's seasoned. He's been trading currencies for years. He understands the mechanics of price. And one day he sees something interesting in the euro to US dollar chart. The pair is in an uptrend. The 50-day moving average has crossed above the 200-day. That's a bullish signal. But James doesn't chase. He never chases. He knows that after a strong move, price often retraces. So he marks a support zone around 1.17 and watches. The RSI tells him something too. Price is approaching overbought territory, so he knows he's not buying yet. MACD is bullish but extended. The market needs to breathe. New traders would jump in. They'd say, "It's going up, so I'm buying." But James waits. Swing traders live and die by patience. Eventually, the pair pulls back to 1.175, right into that support area. Now the structure makes sense. Trend intact, pullback confirmed, momentum stabilizing. This is where a swing trader enters. James opens a long position around 1.175. He places a stop loss at 1.165, just below support. He sets a take profit at 1.19. For him this makes sense. He's risking 100 pips to target 150. A risk-reward ratio of 1 to 1.5. Clean, logical, executable. The next few days require discipline. The trade doesn't explode upward. It moves slowly. Some days it goes up 20 pips. Another day it comes down 30 pips. New traders panic when that happens. James doesn't. He knows the market breathes. He knows volatility clusters. He knows price never travels in a straight line. He simply monitors. Checks the daily close. Reviews the MACD histogram to ensure momentum hasn't completely died. Reads the news but doesn't let it dictate his emotions. Around day 5, price begins climbing. It reaches 1.183. He's up about 80 pips, but he doesn't cut early. Swing traders don't harvest too soon unless the market gives them a concrete reason. By day 7, price approaches 1.187. Now things get interesting. James sees the MACD developing bearish divergence. The candles are still rising, but momentum underneath is weakening. This is critical. Many beginners ignore divergences. But divergences are the market whispering early warnings. James doesn't exit. He adjusts. He moves his stop loss from 1.165 to 1.18. He locks in 50 pips. No matter what happens now, he's green. This is the mental side of swing trading. You're constantly balancing conviction and caution. Suddenly, on day 9, price spikes to 1.19. His take profit triggers. Trade closed. 150 pips banked. That's swing trading. It's structured. It's intentional. And it rewards patience. But the emotional payoff isn't just the profit. It's knowing you executed a plan. You waited for the pullback. You respected your stop. You didn't micromanage volatility. You adjusted when needed. You played the swing, not the noise. And that's what makes swing trading beautiful. It forces you to behave like a professional. There's a famous line from Jesse Livermore, one of the greatest traders who ever lived. He said, "It was never my thinking that made the big money. It was always my sitting." Swing trading embodies that mindset. You enter with logic, and then you sit. You wait. You let the market move. Your job is not to interfere. Your job is to prepare. Beginners often ask me, "But Isabel, how do I know if swing trading is right for me?" And I always say, it depends on your temperament. If you crave movement but don't want the stress of intraday noise, swing trading might be perfect. If you like analyzing charts with calm clarity instead of reacting emotionally every minute, swing trading might be perfect. If you appreciate setups that develop over days, where you can think strategically about your entry and stop, then you'll thrive here. The biggest advantage of swing trading is flexibility. You can trade on your schedule. It works with a full-time job. It works with family responsibilities. You can analyze after dinner, place your orders, and go live your life. Your trades don't depend on you staring at the screen for 9 hours. But this freedom doesn't eliminate responsibility. You still need to review your trades routinely, track your setups, and refine your process. Consistency is the engine. Risk management is the fuel. Swing trading is also incredibly adaptable. Trending markets give you continuation setups. Range-bound markets give you reversal setups. Volatile markets give you breakout and retest setups. And because your time horizon is broader than a day trader's, you're less vulnerable to random intraday noise caused by liquidity pockets or short-term news spikes. But here's the nuance: swing trading does not guarantee less stress. The moment you hold a position overnight, you are exposed to gap risk. If you're trading stocks, earnings can move your position significantly. If you're trading Forex, macro announcements can accelerate or reverse your trend. That's why stop-loss placement and position size are not negotiable. They determine survival. The case of James shows how important this psychological component is. He didn't panic when the trade hesitated. He didn't become euphoric when it went into profit. He simply executed the plan. And the plan is what carried him to the finish line. Beginners underestimate how much psychology matters in swing trading. When you hold a trade over several days, your mind starts narrating stories. You imagine worst-case scenarios. You imagine missed opportunities. The key is to stay aligned with your system. Systems mute the emotional noise. And swing trading teaches you to read the market like a living organism. You start noticing the rhythm of pullbacks, the heartbeat of momentum, the structure of trend phases. The psychology hidden in candles. You develop patience. You develop intuition. You develop the ability to wait for the market to come to you instead of chasing it with desperation. One of the most transformative aspects of swing trading is that it teaches beginners how to think probabilistically. Every trade is a probability distribution, not a certainty. You stack the probabilities in your favor with trend alignment, clean levels, reliable indicators, volatility context, and risk-reward logic. Then you let the math work over time. Swing trading is not about one big win. It's about many structured wins and controlled losses. That's how equity curves rise. The lesson from tip 52, more than anything, is that swing trading gives you space to think, space to react intelligently, and space to grow as a trader. It's a strategy that rewards discipline, not speed. Patience, not impulsivity. Planning, not improvisation. Whether you're just starting out or already gaining your footing, swing trading belongs in your toolkit. Not because it's easy, but because it gives you a structured, scalable way to participate in the market with clarity. As you think about your own trading journey, ask yourself this: do you have the patience to let a good setup unfold? And if you're already swing trading, what's the biggest challenge you face when holding positions for several days? Let me know down in the comments.
Thank you for listening to the Ultimate Trading Podcast by Bells Forex AudioWorks. If you love this episode, hit follow, leave a quick rating, and share it with one trader friend. It really helps. Right now, head to bellsforex.com/tools. 6 professional-grade trading tools, 100% free, no sign-up. Use them on every trade. They're that good. Full guide is free at bellsforex.com or grab the Kindle version on Amazon. Until next episode, trade smart, stay disciplined, and keep building your edge. Happy trading!